Hi there, I'm Sashi Sivram Krishna and welcome to my course Macroeconomics, a Modern Money Theory Perspective. We are in part 1 of the course Macroeconomics and Money. In lecture 19, we will look at the hierarchy of money. We have seen in our previous lectures how anyone can issue money, be it the state, commercial banks, the corporate sector, firms, and even individuals. The problem, however, is to get this money accepted. Obviously, then, all monies are not the same. Money, as we have said earlier, is essentially a financial liability, a promissory note, an IOU, or what we can also call credit or debt. Since money is credit, there must be a credit rating based on acceptability, which then gives rise to a hierarchy of money. All monies are not the same because, as I just mentioned, everyone can create money. The problem is to get it accepted. These were the words of Hyman Minsky, and continuing on the same note, Perry Merling has stated categorically that always and everywhere monetary systems are hierarchical. This is an important aspect of money which is very often missed in the mainstream literature, where all goods and services are normally treated on par. There is no essential difference between goods and services. So, for instance, some textbooks might consider the market for potatoes, some might consider the market for pizzas, and some might consider the market for guns. To a microeconomist, all markets are the same, and we might as well use a fictitious good like widgets, or more commonly denoted by X or X1. When we study macroeconomics and lay emphasis on the notion of money, it is important to recognize this hierarchy of money. All monies are not the same. We can think of the hierarchy of money as essentially shaped like a pyramid. At the bottom of the pyramid would be the promissory notes of individuals as well as households. For instance, when I buy goods and services on credit from a neighborhood grocery store, it is essentially an exchange that I have carried out by issuing a promissory note or money. Obviously, this money does not have the general acceptability in the larger market. For instance, again, the grocery store owner would not be able to exchange goods and services, let's say in the wholesale market, using my promissory note. So all of us can issue money, and this money enables exchange. It contributes to increasing gross domestic product. It leads to economic activity as well as employment. So it does do the functions of money, except that it's not generally acceptable in the larger community. So moving up the hierarchy from the promissory notes of individuals and households, we can look at the promissory notes of firms, or what you might refer to as corporate enterprises, as well as the promissory notes of non-bank financial intermediaries, which we call as non-bank financial companies or non-bank financial institutions, NBFCs or NBFIs. So for instance, a corporate bond or an equity share is a promise to pay. However, there are no guarantees that the nominal value will be repaid. So if you buy a corporate bond at 100 rupees or $100. At the time of repayment, you might get $110, but you might also end up with $90. There is a possibility. Nonetheless, these promissory notes of corporate enterprises as well as NBFIs or NBFCs are certainly superior to those of individuals and households in terms of their acceptability as well as the liquidity that they provide, because we have markets where you can buy and sell these kinds of monies. Above this layer of corporate and NBFC, NBFI money, we have what we call as bank money, commercial bank money. The IOUs of commercial banks are called deposits, which are essentially a liability of the bank. It's very likely that in most exchanges and trade, my personal IOUs will not be accepted. However, the IOU of a bank, a promise to pay of the bank, is likely to be accepted. This is done by issuing a check, which is essentially a promise by the bank to pay or transfer the deposit in favor of the person in whose favor the check has been drawn, or perhaps the bearer of the check. The deposit is also a promise by the bank to exchange their IOUs, that is essentially the deposit account, for state money. Not merely an exchange, but this exchange will be done at par. What this means is that if I have 100 rupees or $100 in my deposit account at a commercial bank, the commercial bank promises to exchange this deposit for 100 rupees or $100 of state money, which is cash. And this will be done at par, meaning for 100 rupee or $100 deposit account, I will get exactly 100 rupees or $100 of state money or cash. This is actually done by design, and it's a very important aspect which has made bank money to be even more widely accepted across the economy. At the top of the hierarchy is what we call as state money, and this state money is used to settle obligations due to the state. Like we discussed in our earlier lecture, this would include taxes, penalties, fees, and so on. And the state by design has also accepted bank money in settlement of obligations due to it. So for example, if I have a tax obligation to the state, I can use bank money, commercial bank money, my deposit in the bank or the bank's liabilities to settle these obligations due to the state. I do not actually need to convert my deposit first into cash or state money and then discharge my obligations to the state. The state will take the bank's liability or the bank's promissory note, the deposit, in settlement of dues to it. And like I said, this has made bank money so much more widely acceptable across the economy today. This hierarchical monetary system provides for ample elasticity, especially in good times, as well as exerts the necessary discipline when the economy moves into a situation of a crisis, economic crisis. What does this mean? Ample elasticity really means that when the demand for credit grows from the growth in businesses of new companies or existing companies, the commercial banking system can respond with an increased availability of credit so that entrepreneurs as well as businesses can put forth goods and services into the market. This is required to sustain economic growth and provide increasing amounts of employment to the people as well as increasing profits to businesses. What happens is when this growth happens over a period of time, we might move into a situation of increasing stress on businesses, increased competition in markets, and so on, where companies are not able to repay debt, repay their credit, which they have procured from commercial banks, so that the assets of the banks, the loans given out to businesses, turn into what we call as non-performing assets or NPAs. So the loans begin to go bad. This is the time when the banking sector and the financial sector comes under stress. And at that time, people might want to convert their promissory notes, the bank's promissory notes, which is deposits, into state money. In fact, the conversion of promissory notes into those higher up on the hierarchy of money becomes common as an economy gets into a crisis. So for instance, if you have the promissory notes of a non-bank financial company, you would like to convert these as quickly as possible during a crisis into the promissory notes of the bank. You want to convert bonds or equity shares into deposits. And if banks are also under stress and a situation arises where banks begin to fail, then you might want to convert deposits into state money or cash. There may be a run on the bank, which is not so common in today's world, but there was a time not very long ago when bank runs were common and people would rush to the bank to convert deposits into state money. And that is the discipline that the system exerts during a time of crisis. Now, at the top of the pyramid is, of course, state money, because, like we said, state money or modern money is essentially fiat currency, which means that you cannot go to the state and then convert their money into anything else, especially commodities like gold and silver. You could convert it into a foreign currency, but it will not be at a fixed rate, a promised rate. It would be at the going market rate, which is determined in a floating or flexible exchange rate market. So this is what we mean by saying that state money is at the top of the hierarchy, and it is what we call as definitive money. There is nothing above state money in today's modern money economy.